Right now, something is quietly rotting inside the American car market. Not a crash, not a headline, nothing with red tickers and screaming anchors. Slower than that. 3 out of 10 people trading in their car right now owe more money on it than it's actually worth. Not a little more, $7,000 more on average. The finance industry has a name for this: negative equity. On the street, underwater. And here's the part that should make your stomach drop. You can't just hand the car back. That's not how banks work. To escape, you'd need to walk into the dealership with a $7,000 check just to break even, just to buy yourself permission to leave. Most people don't have that check, so they don't leave. The dealer has a solution. They call it a lifeline. They take that $7,000 hole and they bury it inside the price of your shiny new car, wrapped inside the monthly payment, hidden under the taxes, the warranties, the junk fees, the documentation charges. That's the debt snowball. You think you're financing a $30,000 car. You're actually signing a $40,000 loan, and the car starts losing value the second you leave the lot. So how do they make that feel okay? They stretch the loan. 7 years, 84 months. Think about that. 84 months. You're paying interest on a car you don't even own anymore for 7 years. And people look at this and say, it's COVID, supply chains, inflation. No, this exact trap, borrowing tomorrow to pay for today, was engineered a long time before any of us were born.
Go back with me. 1890s. Railroad barons, coal fortunes, men who didn't just own industries, they thought that gave them the right to own the people inside them. George Pullman was one of them. He built luxury sleeping cars for passenger trains, made an obscene fortune, then decided to do something that, on paper, sounded almost generous. He built a whole town for his workers, Pullman, Illinois, just south of Chicago. Company houses, company grocery store, company church, company library, company gas, company everything. If you wanted a job building George's trains, you moved your family into George's town. Here's where it turns. George Pullman didn't pay in dollars. He paid in Scrip, company Scrip, a fake currency printed and controlled entirely by the Pullman Company. You could spend it at the company store, pay your company rent. That was it. Take it outside the town borders? Nobody wanted it. It was paper. It was worthless. So Pullman owned where you lived, owned where you ate, owned what you earned, and he priced everything just high enough so that by the time rent and groceries came out, workers had almost nothing left, breaking even every single month. Then 1893 hit, a massive depression. Train orders dried up overnight. Pullman's profits took a hit. His move? Cut wages 25%, immediately. But he did not cut rent, did not touch the grocery prices, not 1 penny. Workers were opening their pay envelopes to find 2 cents, literally 2 cents, after the company auto-deducted everything before their hands touched the money. They couldn't quit, they owed George money, couldn't leave town. Nobody outside would take their Scrip. No savings, no options. Prisoners, made entirely of math. No bars, no guards, just a ledger book. That's what triggered the 1894 Pullman strike, one of the most explosive labor events in American history. Workers walked out. The national rail networks stopped. The federal government sent in the military, because the workers had done something George Pullman never expected. They did the math, and they understood for the first time what had actually been done to them.
Look at the first question a car finance manager asks when you sit down. Not, what's the total price? Not, what's the interest rate? Not, how long? What monthly payment are you comfortable with? That question is not friendly. It's a tool. Behavioral economics has a name for what happens next: hyperbolic discounting. Long name, simple trap. Your brain is biologically hardwired to massively overweight what's happening right now and completely underestimate what happens years later. Every human, no exceptions. The dealer knows this. They know you want the car today. They know your brain is doing math against this month's paycheck, not against 7 years of interest. So they stretch it. 3 years becomes 5. 5 becomes 7. Suddenly, that $40,000 loan produces a number you can picture, something that fits in a budget. But here's what's actually happening underneath. Every single day, that car loses value faster than you're paying down the loan. New cars drop 15 to 25% in year 1 alone. The math mathematically guarantees you'll be underwater before you're anywhere close to equity. And when you're underwater, you can't sell.
Can't trade it with cash, can't move cities, can't leave a job you hate. Not if that job is the only thing covering the payment. You don't own a car. You own a piece of paper that says you owe a very large amount of money to a bank. The car is just what's keeping you showing up to pay it. George Pullman didn't need an armed gate. He had rent and grocery debt. The modern bank doesn't need a company town. It has the auto loan. Same mechanism, different logo.
Real quick, if this is landing differently than you expected, whether you've been here for a while or this is the first video you've ever watched, hit subscribe. I'm not a financial advisor, not a millionaire, not selling a course. I'm someone who goes down these rabbit holes at 2 a.m. and comes back with receipts. New episodes drop every week, and this is just the beginning.
So, where does this leave us? The Pullman strike eventually forced real change. Courts struck down company towns. Scrip was outlawed. Workers got the right to spend their wages wherever they wanted. On paper, we won. But what actually changed? The format. The town is gone. The Scrip is gone. The company store is gone. The math didn't move an inch. The system still needs you anchored to your current income. Still profits every time you refinance, roll over, extend the clock. Still depends on you making just enough to cover your obligations, never quite enough to walk away from them. 84 months isn't a payment plan, it's a subscription to financial paralysis. Here's the thing nobody says out loud. The escape isn't complicated. If you're upside down right now, the single worst thing you can do is roll that gap into another loan. Second worst, accept the warranty. Take the dealer's financing without shopping it. Sign anything longer than 48 months. The escape is boring. Save the gap. Buy time. Sell privately. Downgrade. Hurt your ego for 1 year instead of mortgaging 7 years of actual freedom. George Pullman's workers were trapped because they were paid in something they couldn't spend outside the system. You're being trapped because you are spending your future wages on a depreciating object sold to you as freedom. A car doesn't give you freedom when you're still paying for it in year 6. Money changes. Principles don't.